You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
I would argue that from PEA, preliminary economic assessment, pre-feas and feasibility should not take a company more than 18 months. I've signed off, well over $2 billion of projects in my career, either being part of a team or the head of the team. Whilst I was working for IXM for the last 3 years, I traveled to all destinations where mining was happening. My first year with IXM, I single-handedly did over 40 projects.
Thanks for tuning into Mining Stock Education. I'm your host, Bill Powers. Well, how do we as retail investors go about valuing late-stage explorers, developers, and producers? How do we determine growth? How do we determine if the feasibility studies and what management tells us is accurate so that we can make informed decisions on a risk-reward basis? Well, here to talk all these things through me is Craig Hutton. He's an expert in terms of mining economics. Craig, welcome to the show. And you are the author of a book that I have had for a couple weeks in my possession that I'm slowly going through and trying to comprehend and read again so I can, through osmosis, take in a lot of this information. And your book is called Mining Economics Explained, a guide for boards, executives, managers, and investors. So welcome to the show for the first time.
Well, thank you, Bill. Nice to be here.
Let's go over your bona fides, a little bit about your back story, please, and experience in mining and what makes you qualified to discuss this topic.
Sure, Bill. So I've got 35 years in mining. I started as a geologist in the late 80s, got a bursary with a company in South Africa called Anglo American, a substantial company. It's listed today on the London Stock Exchange. And early in my career after qualifying, I felt that I needed to do something in finance and economics. So I then pursued studies, got a Bachelor of Commerce, and majored in finance and economics. Early in the 90s in South Africa, there was quite an upheaval in the mining industry. And, the focus became on how you actually make money and how you run mines quite efficiently. And so it was a good time to start in the mining industry. And when I finished with Anglo American, I moved on to a company called Harmony Gold Mining Company. And a young mining engineer by the name of Bernard Swanepoel arrived. And he was heralded because he had the lowest cost mining operation in the province of the Free State, South Africa. And he came on board. And one of the great learnings that he really instilled in me in those early days was prioritizing the ore body and really understanding whether the ore body could yield, the results that, the mining fraternity and industry were expecting. And so that was, I spent 7 years with Harmony Gold Mining Company. In that time, the company became the fifth largest gold miner by production worldwide. So it was a great learning ground. From Harmony Gold Mine, I then moved on, took a role with Placid Dome in South Africa at the South Deep Gold Mine, which remains the biggest single resource in the world. And today, Gold Fields owns it. And it's certainly been turned around and producing stellar results today. And from there, I then moved back to Anglo American at head office, and I became a principal mining economist. And back in 2006, 2007, we were involved and part of the team that looked after $120 billion of project pipeline. So it was a big project pipeline in those days. And certainly was the sort of my breakthrough in being able to look at projects internationally. As early as 2006, 2007. I left them and then went into consulting role in 2008 on my own. Fast forward then to 2012, I was asked to go and look at projects in Zimbabwe and came across a company in Zimbabwe called African Consolidated Resources. And we had a look at their projects, and one of their projects was an old Rio Tinto mine called Pix and Peerless. In 2013, the board asked me to join the board and become the CEO. And within the next 14 months, we delivered not only a preliminary economic assessment, but a pre-feas and a feasibility study within 14 months, which really was record time, but it was enabled because of the principles that we applied that are encoded in the book that I've recently published. And so we delivered 3.5 million ounces of gold, a million ounces of, mineral resource, 1 million ounces of reserve, and the valuation was $250 million for a company that was trading on the market for only $25 million market cap. So that was, on a project basis versus market cap at 10 times the return, if you wish. Having left them, I continued with consulting. My role was done with them. And then in 2018, a company called IXM Metals, which is a trading house owned by China Molly, asked me to join them. And I spent 3 years with them, really understanding the sort of trading world and getting sort of a better understanding that end of the market. So, having come up through the ranks, being quite technical, really to round off the edges, if you wish, spending 3 years in a trading house was good experience. And I resigned from them in March of this year, and we're looking at taking a copper mine to market this year.
So
that's in a nutshell.
Yeah, that's an excellent overview. So what was the impetus of this book? Why did you write it? Was it just to put your own thoughts in writing for future generations, or are you trying to make an impact on the industry currently?
Yeah, I think predominantly it was my frustration back in 2006, 2007, and, sitting on a pipeline of $120 billion for Anglo American. And the mantra of the day was go big or go home. And because I had studied economics and, we had developed with Harmony Gold Mining Company an algorithm, fundamentally I knew that the go big or go home without understanding the ore body was problematic. And fast forward to sort of 2012, 2013, metal prices began to soften, and there was the industry was in all kinds of trouble. In those 2 years, it was $120 billion of impairment that was put onto the books, and stock prices crashed. And then sitting back in the aftermath of that, saying what went wrong. So 2015, I wrote a paper which was published in the South African Institute of Mining and Metallurgy, and really trying to set out what the issues were, and really making a case for optimizing that. In fact, the industry creates its own boom and bust scenarios, in that, we expand when the prices rise, we expand too quickly. And then what happens is, because, you have this lead lag effect, by the time prices start to soften, then, the massive production supply comes online, and then it just exacerbates, the price fall. And that's what we saw from 2013 really all the way to probably 2017, 2018, prices were quite muted. We saw, copper, for instance, bellwether bottoming at about 4,500. And then again, it revisited those prices 2019. And so really that experience and almost, this self-implosion of the industry probably really needed to have light shed on it. And then the question was, well, what can we do about it? And I think this book attempts at least to, put the spotlight on the fact that if you understand your ore body and you allow your ore body to tell you what it can sustain, then what will happen is that we don't overinvest in single ore bodies. And in fact, we make the point in the book where, oftentimes investors are asked to overcapitalize deposits, and that always ends tragically. So ultimately, for the investor, and it is, if you wish, almost complex, I guess, for the layman. But perhaps in that there's a message that mining is a complex business, and then perhaps investors should be demanding different metrics now to measure their investment. For instance, I think you and I spoke last week, and I said, one of the measures that I would suggest that investors look at closely is, how many ounce or what's the dollar free cash flow per, ton of copper, pound of copper, or ounce of gold. Because if you measure how much cash is coming out of the operation per ounce produced, it really holds the feet of miners to the fire and keeps them honest.
So what you mentioned that investors overcapitalized some of these projects, but in my experience in the last year in particular, developers are undercapitalizing their capex needed to bring mines into production. So could you address those two things side by side, perhaps?
Yeah, that's not hard to understand. I mean, at the end of 2013, 40 of the top CEOs were asked to leave their companies. They really were scapegoated. Half of the blame, clearly should have been on the CEOs, but I think the other half of the blame was, investors encouraged them. They were rooting for the CEOs to build these big pipelines. And then ultimately what happened is, prices move in cycles. And so the end of the cycle came and it was a bloodbath. It really was. And so the pendulum then swung. And, suddenly, CEOs were very wary to overcapitalize. The market demanded, returns. It demanded that, companies pay dividends. And, mining companies are no different to other companies. That is their role. They should be, paying dividends and not just convince shareholders, look, there's going to be capital growth. And in fact, once I asked a banker, why isn't there a reason for miners to pay dividends? And this was in the 90s. And he looked at me and he said, you really don't understand business. So, there was that kind of, impetus about capital growth in the 90s and the 2000s, and people were less worried about dividends. And then suddenly, the market was dismayed that during that cycle, not enough was paid in dividends. So the pendulum, as I said, swung back. CEOs are reticent now. But as I say in the book, Mark Bristow, who's the CEO of Barrick, which I think everyone knows, Barrick Gold, says, the problem now is we haven't been investing in our ore bodies, and there's a reserve crisis. And so, a reserve crisis now compounded with supply chain issues, demand side, this is creating a perfect storm for much higher prices and incentive pricing. So the question now is, are miners, going to be tempted now to take the mantra on again of go big or go home? And we all know how that story ends. Or is it timely to go in there and say, those miners who perhaps have had the rhetoric that they put their ore body first and the deposit is important, perhaps now is the time for these C-suite executives to really take that mantra seriously about putting the ore deposit first. And then, your investment thesis is based on what can your ore deposit yield over the long term, not just sort of over the short term. And it's really not about necessarily how big you can make the mine. The question is, can you make the mine to maximize cash flow, which implies you're going to get the right cutoff, the right average grade, and the lowest costs.
Craig, everything you lay out makes sense. Now, I was not brought up within the mining industry. I came into mining because I was an investor in gold and silver after the Lehman Brothers crash. So I'm coming at this from a retail perspective, not formally trained in mine finance like yourself. Now, I've asked guests on this show, and I said, are the gold CEOs going to make the same mistake that they made in the last cycle? And I've got both answers. Yes, because human nature is such that we will just repeat. And then another guest said, no, they've learned their lesson. They're not going to do it. Could you make a prediction? Are the gold CEOs going to make the same mistakes of the last cycle?
I think the smart guys won't. And I think the less smart people will. Human nature is, clearly we don't learn from history. And as part of really, did want to write this book earlier on and get it published. But I took my time because behind the book is an algorithm. So it took me a concerted amount of time and some concerted effort to, create an algorithm where, in fact, you can run, multiple scenarios on an ore deposit. And it's really in understanding the ore deposit that, CEOs won't make the same mistake. If CEOs are tempted simply to listen to the noise and suffer, FOMO, as they call it, fear of missing out, I think sadly those CEOs are going to run the risk of, following the herd, trying to increase output at the expense of cash flow, and I think they will be hurt, and hopefully, and sincerely be hurt by shareholders who look at that and go, this is risky if the CEO is driving volumes as opposed to setting the concept that he's actually looked at the deposit and understood the optimal moments for that deposit.
So you've overseen feasibility studies. You've seen feasibility studies, projects going into production. Based on your experience, just empirical experience, what percentage of feasibility studies are actually achieved in terms of the economics while in production?
Really good question. My book speaks to that. Historically, there have been, blowouts in terms of the budget. And I'll get back to, the questions, how many of those projects actually make it onto the bandwagon. But, typically projects suffer, blowouts, and as a consequence of suffering, blowouts on the CapEx side, many projects don't see the light of day. There's been some, horrendous stories about, capital estimates that, were when the final, dollar was put in, or 4, 5, 6 times over the original budget. But coming back specifically to your question, I think it's a case of, how many projects will come online. It's a case of economics, and it's a case of price. So, in the down cycle, a lot of the projects really 3-4 years ago that just wouldn't put their hands up because the price wasn't right are now suddenly looking really good from the economic side. If you look at just technically, the ratio is generally for every 100, geological projects that you identify, only one ever comes through. So that's a statistically, not a good number.
From resource to production, just to clarify, from every 100 resources, one comes into production?
Correct. So the targets that the geologists play with, ultimately, the number that's out there, and certainly that I'm aware of, is of 100 projects that geologists look at estimating, and one of those ultimately will make it all the way through into production. So when you talk about scarcity, there's this idea, Bill, that there's an abundance of resources. There are so many hurdles in the process of actually bringing a project through into production. And today it's becoming a lot harder, with the advent of, ESG, and, miners simply can't just walk into countries and, pick up the tab and say they're buying this. There has to be a lot of engagement on the environmental side. There has to be a lot of consideration, and then clearly on the government interaction. So today there's a lot of hurdles. Europe, doesn't want mining in their backyard. The USA, we're seeing this now, this big tussle on the energy side. You have those who think mining is bad, and there's others who understand that if you don't grow it, as Natasha Fullion says from Anglo Platinum, if you don't grow it, you have to mine it. And so, those deposits that finally put their hand up and CEOs are bringing to the market are, and in this climate, probably projects that one should consider.
You mentioned you
on the merits.
Yes, you mentioned you have an algorithm. So maybe dig a little deeper into that. And how does your algorithm calculate inflation in regards to what we're experiencing this past year in supply chain disruption?
Yeah, so so inflation, Bill, is one of many variables, So I recall back in 2006, 2007, again, as you were getting towards the end of the cycle, inflation was a problem. And, from a pure economic side back then, really inflation was driven by demand. And so, across the board, we saw the inflation of, skilled workers, which we're again seeing today. Skilled workers, the cost is rising quite quickly. When it came to, tires, oil, all the inputs, we began towards the end of the cycle, particularly from 2007 all the way through to 2013, we saw inflation really biting. So the model in and of itself is not a predictive tool in terms of inflation. There are mechanisms that, in the detail you can build in, and, you can get your, in real terms, your investment to rise. And, typically we work with numbers in real rather than inflated sense, because you want to make a decision in real terms rather than inflated, because the moment you put inflation into those numbers, it's really hard to actually make that business decision, right? Because it's really hard to kind of go, well, this is the number, but it's 15 years out because you built some inflation. And the other problem with that is your inflation number that you're assuming correct? So what we try to do, and we found a better management tool, is simply to leave everything in today's numbers real. And then really, if you do want to consider inflation from an investment perspective, you adjust your discount rate. So that's one way of doing it. In terms of
what discount rate do you use, if you don't mind me interjecting? What discount rate do you use? I've been told 17% by other smart people to use that.
Yeah, I mean, discount rates is a subject matter that is, again, a contested field. One of the things when I did my MBA was that, no variable that you put into your model is wrong or right. And that's the beauty of capitalist markets is, you've got to sit there and you've actually got to decide for yourself what you believe the discount rate is or what you believe the inflation is. Because if you're putting your money in, you need to take ownership of those metrics and those numbers. So, Bill, I'm sorry to disappoint you that there's no sort of panacea for, what number do you put in? But I tell you what we also do is early on in 2006, we started playing with Monte Carlo analysis. And, Monte Carlo's, in my younger days, when I first saw it, I thought, well, here's a tool that's predictive. And over the years working with Monte Carlo, I realized that, in fact, Monte Carlos are not a predictive tool. What those tools are is to say, if I've got 50 different variables, and it's not difficult to compile a mining model with about 50, variables. And so when you run it, you get a single number at the end of it. And what you really want to do is test that single number statistically. So you want to go and run 10,000 runs, change all those variables, and you want to stress test all the variables, including inflation, to actually see how robust your model is. And so I would say that if you're just singling out, for instance, inflation, you probably run the risk because, there's other factors also that lead to business failure in mining. Have you got the right recovery grades? What's the price? What are the ranges that you're thinking in? So, feasibly, if you think the price of copper is going to go to $15,000 per ton and the low end is 6,000 tons, you probably want to stress test that. And of course, the other thing in Monte Carlo is you get that wonderful chart that's called a tornado chart. So, you should really be putting your focus on those variables in your modeling that, in fact, have the biggest impact on the bottom line. And that's not to diminish inflation, but again, if you're looking forward and you're saying, well, what's happening? Well, history is always going to tell you. And when you do look at cost curves versus revenue curves, you always see that, in fact, the costs tend to rise with the increase in revenue because actually miners buy what they sell. So they're going to buy the steel, they're going to buy the copper because they have to put in, telecommunication systems, the big vehicles. Now we're having drones. There's a lot of copper that are going to be put into those very vehicles that they're going to use to dig out, the metals that the rest of society consumes. So, what we can do is we can expect inflation to rise in line with prices. And when I do my modelling, and I guess perhaps the answer lies in this, is I will always do my modelling when I'm trying to understand the sort of cut-off grades, the average grades, based on the historical margin. Because if you've got a historical margin, if you put in a price, then costs will eventually sort of revert back to the historical margin. And by de facto, you're accounting for inflation. But what that doesn't do, however, it doesn't account for the sort of volatility or the variability. And again, that's the beauty of markets. Each investor needs to take a view. Don't just take the numbers that they've got. And, if the proposal is that you've got $100 million NPV, factor in some sort of inflationary impact into that number and discount it. So that would be really the best advice. And as I said, sadly, there isn't a silver bullet to give you or your listeners.
Craig, when you were at Anglo American, were you directly overseeing the feasibility studies, or were you subcontracting those out to engineering firms?
No. So, the way Anglo American worked, and I thought it was a really good model, is that they had their own, back in the day, South Africa had these very, very large mining houses. And so the head offices were packed with, very experienced and seasoned miners from all disciplines. And so what would happen, and I was in the economics team, and the projects would come in, and they would come in from all the various different divisions: the copper division, the coal division, the gold division, diamonds. So these would all come in, and then we would look at all of the projects sort of independently in our disciplines. The great thing about being a mining economist is, de facto, you'd have to look at everything that everyone was bringing in, because this is where all the variability was. And, at the bottom line was a consequence of, your mine design, your process design, your geostats and your geology. All of that comes together really in your model. And it shouldn't be an accounting model. It should be an economic model, because ultimately, accountants love to deal with the past. Economists deal with free cash flows and the future. And so it would come to us ultimately, and we'd go through it with a fine-tooth comb. And then we'd either fail it, or we would send it back for review. And then, the other projects that would pass based on the merits and, allowing the ore bodies to put their hand up.
Yeah, there's thousands of retail investors listening to this discussion. So I asked that first question to lead into this question. Can we trust the feasibility studies that are put out by mining engineering firms? Because don't they inherently have a conflict of interest? Because if their client is the mining company, there's kind of a built-in bias, isn't there, to come up with an economic conclusion, but the ore body might not be optimized to the fullest, especially according to your standards.
Yeah, so, what we saw in South Africa, Bill, is that we had, in the 80s and the 90s, we had in-house expertise. And then, sadly, we had CEOs take the helm, and, their brief was cut costs. And, typically, whether it's mining or other businesses, these CEOs come in, and the easiest way to cut costs is to go to the headcount and just start slashing people. And then, the CEO is going to get his bonus because, his story and his thesis is there's too many people. What happens there is that we lose very valuable people, experienced people. And, we, in our business psyche, we just think people are expenses and liabilities. And when that person leaves and walks through the door, with them is a huge amount of intellectual property. And so what happened in South Africa, these very people that they're retrenched, they took their big packages and they sold their own consulting companies. And they would come back clearly at 3 times the rate of what they were employed for. And so when I look back, I kind of think, it was a phase, it was a fad. It was CEOs who were driving their share price, dancing to what the market wanted, and not really thinking through it and making a case for keeping good people. Of course, there's always going to be people who don't meet the mark and probably should move on. But when you start cutting people for the sake of cutting, you're actually going to then build on the cost. So coming back to your question, so yeah, today companies, certainly the bigger companies, because look, the juniors can't afford big teams, they can't afford the overhead, and so they go to the smaller consulting firms. But consulting firms, because they sell hours, are by definition selling hours. So the longer that they can prolong the feasibility studies, the more money they make. And so what's unsatisfactory for me today is that, I've seen feasibility studies last 5 years, and that's a lot of value that gets taken off the table if, the geologists are finished with their resource or the estimation, and it takes another 5 years to come to fruition. I have seen of late, some of the smaller players, they're really accelerating them. So then the question is, how can you accelerate your feasibility study? In my opinion, one of the mistakes was made is the silos between your geologists and then your mining engineers and your metallurgists are very real. And so, the balls are passed into these silos without the teams getting together. And so again, that wastes time, and time is money. In my book, I talk about design theory, and that's really bringing these different disciplines together. And I would argue that from PEA, preliminary economic assessment, pre-fees, and feasibility should not take a company more than 18 months. But here's the thing. The C-suite will have a look at their neighbour and say, look, my neighbour is producing 30,000 tonnes of copper a year, so therefore we're going to do it. And that's a mistake, because you can't look what your neighbour's doing. The ore body is very different. And so, again, this is where, hopefully my book, comes and reconciles that and says, do your preliminary economic assessment, or what I call your viability study, properly. And then basically you have all the metrics by which to then tell the engineers coming in, this is the mine design that I want conceptually, and here are the numbers. And then what you'll find is they become very focused, and you can reduce those timelines. Now, I say that not just as a theoretical idea, is I actually did that back in 2013. And that's how we're able to accelerate from concept all the way through to feasibility study.
Were you managing a third party when you were able to do that in 14 months, or was that internal? How did you accomplish it?
It was a third party. But, what I've done, Bill, is over the years made some very strong relationships. And so the third party was a colleague of mine that we had both been in Harmony Gold Mining Company. And so I have to give him credit, because one of the things that I say in my book is, these are not all new concepts. They're not concepts of my own. But over the years, I've taken the concepts, and I believe it's right to give credit where credit's due. So, Don van Heerden from MiningStockEducation in South Africa is the gentleman in question, and he developed, the first sort of two-dimensional optimization curve. And then, fast forwarding, people like McCarthy and others in Australia have, played around with the hill of value. And so Brian Hall, for instance, is accredited with, coming up and coining the phrase hill of value. And I think these are all valuable concepts that I don't believe are filtered back to the market to say, to the market and retail investors, there are these tools out there that actually haven't received sufficient attention even within the mining industry. And I hope that, given my experience, given my, ability to have said, hey guys, I can do from PEA to feasibility within 14 months, that it encourages retail investors to be saying to miners, well, we know you guys have the tools, so why are you taking so long to bring these projects to fruition?
Excellent.
And I think it's right that investors put the pressure on mining houses and mining companies to do just that.
Well, that's one of the turnoffs of developers, honestly. They're in that boring stage of the Lassonde curve, and then everything seems like it takes so long. And then when there's uncertain macroeconomic conditions, it makes some developers less attractive. So if you can speed us through that down trough of the Lassonde curve, you're going to attract more retail capital in particular.
Indeed. And, I think, I'm quite disappointed, Bill, with, I read through a lot, and I've signed off, well over $2 billion of projects in my career, either being part of a team or the head of the team. Whilst I was working for IXM in the last 3 years, I traveled to all destinations where, mining was happening. My first year with IXM, I single-handedly did over 40 projects, which is quite a tall order. And so, having looked at the breadth of projects all around the world, I'm convinced that, miners can accelerate their projects. They can reduce that down curve, as you say. But what do they need to do? They need to do their preliminary economic assessments properly. And what I'm seeing is, sort of those now charged with doing preliminary economic assessments are kind of doing a pre-feasibility. And that's what my book tries to address, is that a preliminary economic assessment, from my perspective, is a viability study. And I make the distinction between viability studies and feasibilities. Feasibilities is really where the engineers get involved and they go, right, so we've seen the viability of this deposit. Now let's just work through the engineering hurdles that we have to now resolve. And so in PEA stage and the modeling that I do, I can, in a very short space of time, churn out, 5 or 6 different options that engineers can look at. And then, when you get to your pre-feasibility stage, we can be saying, well, of these options, for these reasons, those options aren't feasible. But each of those options has its own hill of value. And I think when you start to do that, and that's what's really held, people back, is that when you go to an engineering house, time's money, and you say to them, give me 6 options, you're going to write a big check for that. Whereas what I've tried to do within a spreadsheet environment, we can, within a very short space of time, 3 to 4 months, generate 6 or 7 different options and have them tested in that space. And then in addition to that, the PEA, what it really should be doing, and it isn't done enough in feasibility studies, you give it to the engineering department and it becomes a very technical study. And yet when you have a look at the codes, they say you should be looking at the politics. You should be looking at environment. You should be looking at, the social issues. Economics should be fully explained. And then obviously technology. So when I look at those, there's a preoccupation with the technical issues. And yes, there is some of the others, but it's done quite lightly. And I think at the PEA stage, frankly, that's where you should do what they call the pastel: politics, environment, pastel, social, technology, economic, and legal. And so it should be dedicated on that. And then, that's the right space to be talking about, the new ESG hurdles that are being thrown. So that really needs to be done at viability stage, because you may have a great deposit. It's just simply not viable because there's an environmental issue. And, if you give it to the engineers prior to having done that work, you've just wasted a whole lot of money, because they'll get to that at the end of, a 6 to 12 month cycle and say, we can't do that because now we've discovered a viability issue. It's not viable because, land tenure is a problem.
Craig, there are cynical investors that say a PEA is nothing more than a marketing document. Would you agree in part with that statement, or do you believe there's true value in it?
The cynical investors, is a reason why they're cynical, because they've probably had an experience. And, the answer to that is, yeah, it can be. But I think, it's for the market to be saying, well, explain to me the PEA, explain to me what you've done. So, I think to be cynical and then walk away would potentially rob you of value that could be had by doing the PEA. Now, one of the things that, and it's really great in the Canadian space, you have these codes such as JORC, SAMVAL, SAMREC, the SIM codes in Canada. They're the only codes that recognize a PEA. And in that space, what was the distinction between a feasibility and a PEA? And that really came down to the technical assignment of a resource versus a reserve. Now, in the categories of resource, as you know, you have inferred, indicated, and measured. And in your reserve, you have proven and probable. Now, you cannot transfer your inferred resource into reserve because they suggest it's too speculative. The problem that everyone struggles with is that, and again, it's a cost-to-benefit relationship. How much drilling do you want to do and spend, and how much time and delays it's going to have? So you may have well-defined your inferred resource, and maybe only 25, 30% is taken to the higher categories that are then transferred to reserve. So if you're only doing your estimation or your valuation rather on your reserve, you're not telling the market actually the big picture. And so, all kudos to the Canadians for saying, yeah, we want to see the PEA. And again, what the codes talk about is, you have to be transparent. So the real question is, can you recreate and repeat what the mining company has done? Is there more risk? And again, that all depends. It depends on the ore body. So again, it comes back to what ore body you're having. Again, you have VMSs, you have sedimentaries, you have skarn deposits. All of these different deposits have inherent different risks and have inherent different economic signatures. So, I wouldn't take someone who's cynical to task. What I would say is perhaps don't throw the baby out of the bathwater and miss a great opportunity. Have a look at the big picture, and then, at the feasibility stage where things are a lot tighter, there's value in that as well.
When we spoke last week, I was furiously trying to jot down some notes. So if you heard the keyboard clicking, it was because I was writing things down. And one thing I wrote down here is that you learned from your trading house to ascertain risk. And then I asked you what questions I should ask CEOs. And you said, show me all your Monte Carlos and hills of value. So I'm, of course, not as informed on that as you are. But let's say you're talking to a CEO in charge of a development company, and you say, show me all your Monte Carlos and hills of value. And he goes, what? How would you respond? You immediately walk away, or is he bluffing? Like, what would your interaction look like in that scenario?
If I was a retail investor, if you read my book, I think you would probably appreciate why I say that. The hills of value are really there to say, what is the right size of your scale, and if you haven't done a hill of value and optimization, and you're saying, well, we're going to do 100,000 tons throughput or 200,000 tons throughput. My first question, Tim, how did you determine that? And that might become a lengthy conversation how you determine it, and you'll probably say, look, you sent it to the engineers, and this is what the engineers came back with, and I'd be going, that's not really acceptable, because you haven't told me how you got to the optimum scale. And so what you're asking me potentially is to risk overcapitalization. So unless you can prove that to me, I'm not going to invest in your business. The other one is, how much of your ore body should you be extracting? So you have some engineers who believe total extraction. The problem with it doesn't pay the bills. And one of the big bills that you have to pay are shareholders, retail investors, who are putting their money in, early investors. And they want, alpha. They want maximum return on that investment. So if you're simply going to mine your whole ore body, you're going to get suboptimal returns. So that hill of value, in my opinion and my experience, is a critical component, and one that retail investors should be saying to miners, if you come for investment purposes, show me your optimization study. And one of them is, the hill of value is a great tool. It's a great visual tool to see very, very quickly how they've done that. So that's so much for return and investment. The other part is that, have you really quantified your risk? Now, I'm not suggesting necessarily that a Monte Carlo is going to be able to capture all of the risk, but in terms of the majority of the risk, it's going to give you a sense of what those ranges are. So if I were to come to you, Bill, and I said, look, I've got a copper mine that I want to go invest, and my NPV is $100 million at a 10% discount rate, and you go, great, let's talk inflation, let's talk commodity prices, let's talk your assumed recovery rates. How do you know what the sensitivity of all the variables in that soup impact on that single number that they've put out there? And so you're really wanting to ask them, what's the range? What's the range of value that you're going to create? And I think, between those two, right at the top, obviously they filter all the way back down to everything that the miners do, are two really good metrics, if you wish, on a dashboard to be saying, if I have those two pieces of information, I can make a very good and well-informed decision.
My last question, because I know we have a time limit today. An ore body that was in production, that there's still a resource there. It's not in production, but there's a group that gets control of this asset in order to bring it back into production. From your perspective and from a modeling and investment perspective, could this be more attractive because there's obviously infrastructure, assumingly already in place, and then the metallurgy is already going to be known because it's already been in production? What are some thoughts on investing in a project like this?
Bill, you're putting me on the spot again. And every good geologist will say to you, it depends, and so will an economist. So it depends squared, right? I love old deposits, and the reason I love old deposits is they have this wealth of information. So a lot of people look at these, mines that have been mined, and they just look at the infrastructure. So look at, in terms of capitalizing, it's going to be lower. And I go, well, the RP in terms of all the data that you have is probably a lot of more value than, just the infrastructure. And I'm not, downplaying, the infrastructure. But again, in my experience, I've been to some of these older mines and, frankly, the ore body just says, look, I'm exhausted. And so again, it really comes down is, where it depends is, do you understand the ore body and have they articulated the ore body? So when you're doing a mining investment, really forget about, upfront, your first, forget about how much money you have to put into it, forget about scale. Really be asking the questions is really explain to me in layman terms what the ore deposit looks like and can we sustain production? And again, I come back to, is this viable? And I don't think, current miners sufficiently talk about the viability of the deposits. And so once you've got over the hurdle, it's viable and they can articulate why it's viable. So, for instance, in South Africa, which is probably a bad destination to invest money in, but Orion Minerals, for instance, are looking at the old Priska mine, and they've, right at the bottom, they have an ability now with all the geology they've done to go and redevelop this mine, and it looks very attractive. But in terms of viability, then you have to be asking your question, do you want to be putting your money into, a country like South Africa, which is, not really a good investment destination? And I say that as a South African who lives in South Africa. There are other destinations, for instance, Botswana, Namibia, and others in Southern Africa that are much better investment destinations. So, coming back to your original question, these old mines, are they better than, assume by inference, virgin territory? Again, ask the questions around the deposit and understand whether, it's viable.
Craig, your book again is Mining Economics Explained, a guide for boards, executives, managers, and investors. I'm going to link to that in the show notes to Amazon for both US and Canadians. And I know there's people all around the world listening and watching, so just find your Amazon link. Or is there another place on the internet where they could buy the book?
There's also Smash Books, so I can send you that link as well if that helps your listeners, Bill.
Excellent. And is there anywhere online where you would want to be followed? LinkedIn or any other social media presence you have?
So I'm not the biggest social media bunny. I do have a LinkedIn account. So you're welcome to LinkedIn, either follow me or send me a request, and I'd be happy to receive your request and engage with you. And, if you have listeners, you want to drop me a line on LinkedIn, always happy to take your message and try to give you some advice the best as I can.
Excellent. And I'm going to put that LinkedIn link in the show notes as well. Craig, really appreciate the hour you gave us today. Thank you for your insights.
Well, thank you, Bill, and hopefully your investors get some value from my ramblings.
Absolutely, and it wasn't ramblings.